Hey, welcome to the Worry Free Financial Podcast. My name is Eric Ebers, and as always, my goal is to help make finances worry free for you. I always go through a format where I share something going on in the economy today that can apply to most people. Some brief tips on different areas, insurance, investments, and a few others on just some things that can help you make a better financial plan for your future. And then I go into one major key area that I talk about, and today I'm going to be talking about health insurance. And so I'm going to go ahead and just jump into our economic update. And one thing that's really been kind of coming around this last week or so is that there's some talks now about a stimulus package number 2. Many people still haven't received their check for the first stimulus package, but round 2, there is talks about this, but really what's happened is there has been a lot of unrelated stuff thrown into this bill that's going to push out the potential for this to come out quickly. And so do I think that there will probably be a stimulus package 2? Probably. If I were to guess when, we're probably looking at maybe sometime around the end of summer. I don't think it's going to happen anytime soon. I know there's been a lot of people that have maybe lost jobs, they haven't been able to get on unemployment yet, that maybe have been counting on this. Unfortunately, this isn't going to be something that's going to help you out in the immediate future. But let's go ahead and dive into our money saving tip for the day, and this really kind of ties into the real estate area, is the power of doing a refinance. Most people will do a refinance for 3 purposes. That's either to lower your interest rate, keeping the same term that will lower your monthly payment, get cash out to pay off maybe other debt or for an investment that maybe makes sense for somebody, or to get a lower interest rate and shorten your term. Typically those will go hand in hand, but you're going to probably have a higher monthly payment. Over the term of the loan though, a 15-year loan versus a 30-year loan is going to be about 30% less expensive in terms of the interest cost. But let's just give it a quick example of what it looks like. If you were to have a 30-year loan, you're going to refinance to a 30-year loan, what that looks like. So let's say you save 1%. So you go down to a 4% from a 3%. On a 30-year loan, you're usually going to save about 10% of the loan cost doing that. So here's an example. If you had a 4% interest rate on a $300,000 30-year fixed loan, you'll pay $515,000 for that $300,000 loan. If you did the same loan but with a 3% interest rate, you'd pay only $455,000 for that same. And so you're saving $60,000 by saving 1% on that scenario, and that equates to about $150 a month. So that can be a really great way for you to kind of give yourself a raise by saving some money. Now jumping just kind of into real estate, is that real estate rate or interest rates are at a low point right now that we may never see again. I put on there just a snapshot of even my business card, but I am a licensed mortgage loan originator, and if you're interested, I can help see if a refinance would make sense to you. Right now, you can probably get a conventional loan for 2.5 to 3% interest rate. Cash outs are more expensive, and jumbo loans are more expensive. So a jumbo loan is something over about $510,000. So if you're thinking of wanting to do a refinance and you fit into either of those categories, more likely than not, you're not going to be able to get that same rate, and a lot of that's due to even some of the forbearance right now that's been offered as part of the stimulus package. Lenders are increasing the price because of the level of risk on some of those loans. Jumping into insurance, this really has kind of been a hot topic, is identity theft insurance, because there has been a significant spike in identity theft with unemployment claims and stimulus check fraud. And so typically there's about almost 10% of people have their identity stolen each year. But that's probably going to even look a little bit higher this next year with the amount of unemployment and stimulus check fraud that's been happening, where really what happens is criminals take advantage of these scenarios where there's a crisis. there's a high demand when they know what's happening, and so unfortunately that's been happening. And just to give you kind of some information on some steps you can take to protect your identity. One is the very most basic option. It's free. Go to annualcreditreport.com and you have access to run a report on all of the three major bureaus, Equifax, Experian, and TransUnion, to see if there's any red flags on your credit report. Another option is using Credit Karma, where you can get some basic free monitoring and credit score. Comprehensive coverage is going to be coverage that not only monitors, so gives you kind of a snapshot of if there's any red flags or your credit score, but it also will help you if your identity was stolen. It will help you restore that instead of having to go through the time and cost to do that. And it will protect you on any assets you may have lost because of that. And so what you're looking at is probably about $15 a month for about $1 million policy on that. And then the last option, that's probably the very safest option if you fit into this category, is to freeze your credit. So if you're at a point in your life where maybe you don't plan on taking out any more future loans, freezing your credit could be a great option for you. It will make it so that no one can use your credit again in the future. So that may be an option for you as well if you're at that point in your life. For investing in retirement, I'm really just going to talk about a kind of a principle of investing, is the power of compound interest. And just to kind of summarize what compound interest is, it's earning money on your money. And so I have a little example. I'm going to step aside so I can make sure you guys can see. But in this example, I've put three different people. Jim represents the blue line. He contributes $5,000 per year between age 25 and 35. Never invests again. So he invested for 10 years when he was younger, never did it again. He ended up with about $600,000 when he was 65. Bob contributes $5,000 per year between age 35 and 65. And he only ends up with a little over $400,000. And Susie contributes $5,000 per year, starting at age 25 and doing it until she turns over 65, and she has over $1 million in retirement. And one thing that this illustrates is that the earlier you start, the more effective you are, and the more you continue to pour into your investments and your retirement, the more potential you have to grow your retirement fund. And so that's just what that kind of shows, is the power of compound interest. And this works exactly the same in the opposite direction with debt. So if you have credit cards with significant interest, you're paying compound interest. And so instead of working to help improve your future, you're kind of destroying your future with credit card debt. And so just keep that in mind when you're planning out your finances. And now jumping into our key topic this week is health insurance. And two questions I put out here are, who needs it and when should you have it? And my answer would be that everybody needs it and all ages should have it as well. I've known a couple of different scenarios. I've heard many stories, but I've actually personally known a couple of people that didn't have health insurance. Something major happened, some major event, and for one family it was a couple $100,000 in medical bills. For another it was over $1 million in medical bills. And if you don't have health insurance, it's almost a recipe for bankruptcy if something like that does happen to you. And it's really something that I would say is the most foundational part of your financial plan. You can do everything right, not have health insurance, and it can destroy your plan and your future. And so please make sure you have health insurance. And then just a couple quick did you knows. Did you know that medical bills are the cause of 62% of bankruptcies? And did you know that you're 7 times less likely to receive critical care if you are uninsured versus insured? So you're going to be more healthy physically and financially if you have health insurance. So what are the main types of health insurance? Typically you're going to have, these are just kind of the big 3 that I would say. There's a couple of other options, but these are the 3 most common, is managed care plans, Medicare, and Medicaid. And so a managed care plan, these are going to be types of healthcare plans where your insurance company that is your provider is contracted with other healthcare organizations, and they've created kind of a network of providers that they're contracted with. You may have heard of the terms HMO, a health maintenance organization, or a PPO, preferred provider organization. Those are types of managed care plans, and my best way of summarizing those is an HMO is going to be less expensive, it's going to have fewer options, and it's going to be more restrictive when you do need your care. And so basically what that might look like is you may have you're going to have a lower premium. You're going to have, when you need to go see a provider or a specialty, you're going to have a specific referral, versus a PPO, you may not need to have any kind of referral to be seen. And you're going to have to see a specific person versus a preferred provider organization. As long as you're seeing somebody within that network, you're okay. You don't have to have a specific doctor potentially being your healthcare manager. Medicare is available if you're 65 or older, or if you have certain disabilities. One example would be end-stage renal disease. If you do have end-stage renal disease, you're on dialysis. Within 3 months, because of the cost of dialysis, after 3 months of having end-stage renal disease, you qualify for Medicare. Unless that's changed over the last couple of years, that's what that looks like. And generally, when you become eligible for Medicare, you should go ahead and apply for that. For Medicaid, Medicaid is for people that meet certain requirements. So that may be factors like your age, you're above a certain age, your income's below a certain level, you potentially, if you became pregnant, or if you're blind or disabled, you may qualify for Medicaid. So make sure you're looking at that if any of those apply to you. Moving on to how do you get insurance, I think for the majority of people, you probably get insurance through your employer, which is called group insurance. You can also get insurance here in the state of Washington. There's Washington Health Plan Finder, where you basically are, you choose an individual, basically like a private insurance there, and potentially have some support on paying your premiums through that. When can I change my insurance choices? And so typically you're going to get a chance when open enrollment starts, which is typically going to be leading into a new calendar year. So before probably November or so, you're going to have options to enroll. Or if you have a life-changing event. And so one thing I want to point out is if you lost your job, that probably qualifies as a life-changing event. And so you may be able to get onto a spouse's insurance or have other insurance potentials that you wouldn't normally have. So make sure that you're checking that out to see if you can get insured. Other situations would be if you got married, you got divorced, you gave birth to a child, or if you moved out of state and you're no longer within the boundaries of your insurance, you would qualify for a new insurance, a life-changing event there. So what are some of the most important factors to consider when choosing your insurance? I'd say one is your medical needs. So that's your age, your health, maybe if you anticipate having some sort of an elective surgery over the next year, that could be a situation where you would consider in terms of what kind of insurance should I look at. I may have a lot of health expense. I may be willing to pay a higher premium so I don't have to have as high of a deductible or out-of-pocket max. Premiums are the monthly charge for health insurance. Deductibles are the amount that you're required to pay out of pocket before your insurance provider pays. Your out-of-pocket max is the absolute max amount that you would pay for any insurance over the year. Co-insurance maybe looks like a percentage of a bill that you're responsible for, or you may see, or co-pays is another one where you may see a flat fee that, you're required to pay $20 fee for this prescription or for this doctor's visit. Then there's things like in-network versus out-of-network to consider. If you're in an area where maybe you don't have the doctor that you really love isn't in-network, you may consider going to a different plan that doctor is in-network. And then sometimes there's certain types of coverage that are excluded, so you'll want to be making sure that any specific scenario you have a health need for, that it's included in your insurance plan. So I just put real quickly, I'm going to step aside so I can walk through this, a sample of what an insurance plan might look like. You may have 3 different choices: basic PPO, PPO with an HRA, and a high deductible health plan with an HSA. And typically premiums, and I'll show you a premium sheet that corresponds with this in a minute. You're going to have lower deductibles and lower out-of-pocket maxes typically with your higher premiums as you work through these. And it may be the opposite direction, but as deductibles and out-of-pocket maxes go up, your premium's probably going to come down. You can see here, so here's where it talks about annual out-of-pocket max, deductibles up there. Here under some of your general service, so 80% after deductible, you would be responsible for 20% of your bill after you met your deductible. Here's just a corresponding premium sheet that might look like that. And then this is just kind of something that everybody should do, I believe, is a kind of cost analysis looking at, okay, here's our premiums by different scenarios up here. Maybe your employer contributes to certain types of things. It's very common for employers to contribute towards an HSA. But you want to factor in, okay, if with the PPO you're going to pay more during the year for your actual just being insured. And depending on how many different costs you have, surgeries, procedures, prescriptions, it'll help you decide whether is it worth more to pay for the higher amount to have insurance to have lower bills throughout the year, or does it make more sense to have lower costs to have insurance and maybe I'm responsible for more? If you're maybe a healthier person typically, you probably would maybe lean towards the more expensive for the actual care, less expensive to be insured. And then this is something I've shared before, and I'm going to share it again. My favorite favorite way to pay for healthcare costs is through a health savings account. And what's so great about this is that it is tax favorable. You'll never pay tax on it as long as you use it for medical expenses and qualified medical expenses, and you can invest it. And so it's the only thing that's tax free and can grow over years. And so the one thing to note is it attaches to a high deductible plan, so if you can't afford a high deductible, this probably doesn't apply to you. If you can, this is an amazing investment. The average couple will spend $387,000 on healthcare costs after age 65, so this is a great way to be able to help save for some of that. That's all I have for today. Next week I'm going to be diving into other insurance types, but if you have any questions, feel free to email me at worryfreefinancial@gmail.com for coaching, and for any kind of mortgage or refinance, Eric@ccm.loans, and I hope to see you next week.